Welcome to the Deep Dive, where we unpack complex information to give you the most valuable insights. This week, the Forex market seemed to just throw out the rulebook. Seriously, some curveballs caught a lot of people off guard. We're going to break down how seemingly, bad news suddenly became good news, why geopolitics seem to trump economic data sometimes, and crucially, what that means for your decisions in the market.
Absolutely. Our mission today really is to distill those 10 biggest market-moving events, the ones that really shaped currencies this past week, June 21st to the 28th. We'll use our analytical framework to show you the real impact of each event, and most importantly, pull out those strategic lessons, help you navigate these, well, tricky waters.
Okay, let's dive right in. First major mover. The US PCE, that's the Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge, right?
That's the one.
And it came out alongside personal income and spending data, June 27th. This really looked like a stagflation surprise, didn't it?
It certainly did, yeah. The U.S. Bureau of Economic Analysis, they delivered a really conflicting picture for May. We saw core PCE come in hotter than expected, 0.2% month over month, 2.7 year over year. But then you had personal income unexpectedly dropping by 0.4% and spending dipping 0.1%. It was, a classic signal of underlying stagflationary pressures brewing.
Wow. So hot inflation and falling income and spending. Okay, my first thought, honestly, would be, uh-oh, inflation's sticky, Fed stays hawkish by USD. How did the market actually take that? Because I've got a feeling it wasn't quite so simple.
You've nailed the critical point there. That would have been the classic first-level thinking trap. A lot of people probably fell into it. Despite that hotter inflation number, the two-year Treasury yields, they only ticked up slightly on the day. But what was really telling was the weekly trend for those yields, sharply down, about 15 basis points lower on the week. So that clearly told us the market chose to prioritize the weak growth data, the falling income and spending, over the inflation number. And that significantly boosted expectations for Fed rate cuts.
That's fascinating. So wait, bad news for the economy somehow became good news for, like, risk assets?
Precisely. That's exactly what happened. The initial volatility was high. You saw some whipsawing. But the market quickly settled on this bad news is good news narrative. The VIX index, the market's fear gauge, it actually fell, which suggests reduced short-term uncertainty even with such a contradictory report. Strange, right?
Yeah, very strange. And you likely saw speculators dumping their US dollar-long positions, especially against currencies where the central bank is maybe more dovish. And here's where it gets really interesting. A crucial cross-asset correlation shift occurred. The normal link, strong dollar index, DXY, usually means a weaker S&P 500.
Right, that's the usual playbook.
That reversed, completely flipped. The S&P 500 surged to all-time highs while the DXY weakened. That signals a new market regime, basically, where bad economic news is welcomed because it means potentially more Fed liquidity down the road.
Okay, so the huge takeaway here is you absolutely cannot just trade the headline number. This week, hot inflation didn't equal a stronger dollar. It actually signaled a deeper market fear of recession, and that just flipped the whole script. Exactly.
Yeah.
A simple buy USD on hot CPI strategy. It would have failed miserably. Successful strategies probably involve things like mean reversion, selling the dollar after that initial spike, or even breakout trading, but in the counterintuitive direction, buying stocks, selling the dollar once that bad news is good news. Interpretation really took hold. It just hammers home the point. You have to analyze the entire report, the whole picture, not just one number.
That's a really powerful lesson in market psychology right there. Okay, so while these economic numbers were pulling the market one way, we had this huge geopolitical shift around June 24th, the Israel-Iran ceasefire agreement. How did that ripple through the global risk landscape, especially when traders were maybe focused on, say, the PCE data?
Yeah, that was another major piece of the puzzle this week, a huge turning point. News emerged, brokered by the U.S., of a ceasefire between Israel and Iran that significantly eased Middle East tensions. And that acted as a really powerful catalyst for a global risk-on sentiment shift, almost overnight.
Okay, and the market's immediate reaction to such a big de-escalation.
Well, directly on interest rate expectations, not much immediate impact, but indirectly. Lower oil prices definitely eased inflation pressure. That gives central banks a bit more dovish breathing room later on. We saw implied volatility. The market's expectation of future swings for oil and also for safe haven currencies like the Japanese yen and the Swiss franc, it dropped sharply. The VIX probably dipped further too. This triggered large liquidations. People who were long crude oil futures betting on conflict, they got out fast as that geopolitical risk premium just vanished. And it also caused closure of safe haven longs positions betting on yen strength, Swiss franc strength, gold strength. Gold actually fell below $3,300.
So a clear, decisive risk-on signal pretty much everywhere you looked.
Yes, absolutely. Sentiment turned strongly positive for risk assets, think stocks, the Aussie dollar, the Kiwi dollar, and decidedly negative for those safe havens, JPY, CHF, gold, and obviously oil. The news headlines just pivoted from conflict looms to ceasefire agreed. And it also strengthened that negative correlation between oil prices and risk assets like the S&P 500.
Okay, so here's where that interplay gets really critical. This massive geopolitical catalyst happened right in the middle of all this confusing economic data. What does that tell us about, like, prioritizing news flow? Which signal do you follow?
It's a fantastic question. And this event really highlighted how geopolitical catalysts can sometimes just completely override simultaneous economic data. So if you were trading purely on, say, domestic UK news, maybe selling the British pound because the Bank of England seemed dovish later in the week,
Mhm.
you might have been completely blindsided by sterling strength, which was actually driven by this global risk-on wave.
Right.
Recognizing that dominant risk-on flow, driven by the ceasefire, was absolutely key. And it made the sell-the-fact strategy really profitable for anyone who had perhaps bought oil or safe havens on the rumors of conflict escalating earlier.
It's fascinating how those big global themes can just swamp the local picture. Like you mentioned, the Bank of England's rate decision. Even a dovish Bowie couldn't fight that broader market current after the ceasefire news broke. So what actually happened with the Bowie? That was June 19th, but the impact really hit around the 26th.
That's right. The Bank of England's Monetary Policy Committee, the MPC, they voted 6-3 to keep the bank rate at 4.25%. Now, the market was mostly expecting a 7-2 split, so having that third dissenter vote for a cut was seen as more dovish. And then Governor Bailey's comments afterwards, talking about a weakening labor market, that just reinforced expectations.
Okay, and how did that land with the market specifically for the pound?
Well, UK two-year gilt yields fell sharply, reflecting that increased chance of rate cuts. And the forward points on GBP pairs, which, essentially bake in the interest rate difference between two currencies, they repriced pretty quickly to reflect a more dovish Bowie path. Volatility on sterling pairs, it spiked on that surprise 6-3 vote, but then it settled down at a new, maybe slightly lower baseline as that dovish interpretation became the consensus. This dovish surprise probably triggered liquidation of hawkish Bowie bets. People betting on hikes had to unwind. It might have even shifted speculators towards being net short sterling. Sentiment definitely turned decisively dovish for the pound itself, with headlines all focusing on that dovish split.
So on paper, purely looking at the Bowie, you'd think, okay, sell GBP, but that's where the global picture messes things up again. What's the sort of fundamental principle traders needed here?
The big lesson, again, is that sometimes even major domestic news just gets drowned out by the global tide. If you were shorting GBP USD purely based on that dovish Bowie news, you probably got stopped out or lost money when the pair rallied later, driven by that broader risk-on mood and general US dollar weakness. It just emphasizes how vital a multi-factor approach is. You can't trade in a vacuum. Interestingly, hedging a GBP USD short by maybe going long, EUR GBP betting on the euro outperforming the pound could have actually been a profitable relative value trade in that environment.
Okay, that makes sense. Let's shift hemispheres now down to Australia, their monthly CPI on June 25th. What did that data tell us about the RBA, the Reserve Bank of Australia, and their next move?
Right. Australia's May CPI, it came in significantly lower than anyone expected. Headline inflation dropped to 2.1% year over year, down from 2.4%. And the trimmed mean measure, which is arguably more important as it strips out volatile items for a clearer underlying trend, that fell to a 3.5-year low of 2.4% year over year. This data, it pretty much cemented expectations for an RBA rate cut in July. It almost guaranteed it.
Okay, so a very clear signal for a rate cut down under. What was the immediate market impact? Did the Aussie dollar tank?
Australian 2- and 3-year government bond yields plummeted. The market immediately priced in something like a 90% probability of a July rate cut. Bang! Initial volatility on the AUSD pair was high, with a sharp downward move straight after the release. And this likely triggered liquidation of any remaining speculative Aussie dollar long positions, mainly because the data was quite a surprise. It was weaker than feared. Sentiment for the AUD turned distinctly negative. The whole narrative shifted from, will the RBA cut, to, okay, the RBA is definitely cutting in July.
So was this one a straightforward breakout opportunity to the downside? Or, again, were there other forces at play, those global cross currents we keep talking about?
Well, it was kind of a reverse buy the rumor, sell the facts scenario, if you think about it. The market was already leaning towards an RBA cut, maybe not with 90% certainty, but leaning that way. This data just confirmed it emphatically. So the initial sell-off, the breakout lower, that was the correct immediate reaction. But taking profits quickly was crucial. Because much like the British pound, the Aussie found its footing later in the day. Why? Because of that strong global risk-on sentiment and the broad US dollar weakness that were dominating everything else, it really highlights, again, the need to constantly assess which themes are dominant in the market at any given moment. Is it the local story or the global one?
Absolutely. Now let's head over to Germany. The IFO Business Climate Index, June 24th. After some of these complex, contradictory signals we've been discussing, this sounds like it might have been a bit more straightforward, maybe a bright spot for the Eurozone.
It was indeed a bright spot, yes. Germany's June IFO index rose to 88.4. That's a one-year high, and it comfortably beat expectations. What was really encouraging was the big jump in the expectations component. That suggests German businesses are genuinely regaining confidence about the future.
Okay, a clear positive surprise. What was the market reaction for the euro?
This put some upward pressure on German bond yields, especially the shorter-term ones. It basically reduced the perceived urgency for the European Central Bank to make deep rate cuts anytime soon. We saw a significant spike in volatility for euro pairs, EUR-ZD, EUR-JPY, EUR-GBP, because it was such a clear, positive surprise, no ambiguity. It likely encouraged speculators to close out their euro short positions and maybe even build some new longs. It challenged that prevailing narrative we often hear about, persistent eurozone weakness. Sentiment for the euro shifted strongly positive off the back of this. Headlines started focusing on German resilience and an improving outlook.
So we talked about some bull traps earlier with things like the US PCE. Was this a clean breakout opportunity then by the euro?
Absolutely. I'd say this was a perfect example of an event tailor-made for a breakout strategy. The data was undeniably positive, it provided a clear catalyst, and the move higher in the euro was sustained. Traders buying USD, for instance, on a break above the levels seen just before the announcement, they likely captured a strong, relatively low-risk move. It really showed that despite those powerful global themes, a strong enough domestic data point from a major economy like Germany can still independently drive its currency, at least for a while.
Okay, let's circle back to the U.S. consumer confidence from the conference board, also on June 24th. Now, given what we later saw with the PCE data and the market's reaction, was this report maybe an early piece of that bad news is good news puzzle starting to form?
Exactly. That's a good way to put it. The Conference Board's Consumer Confidence Index, it fell quite sharply in June, down 5.4 points to 93.0. That erased almost half the gains seen in May. And the declutter was pretty broad-based. People were citing concerns about tariffs, about inflation, the usual suspects. Now, it didn't cause a huge immediate market reaction in terms of interest rates, but it definitely reinforced the case for a more dovish Fed down the line, contributing to keeping those Treasury yields low.
So more of a sentiment shaper than a big market mover in its own right.
That's right. It wasn't a major volatility shock like the PCE data was later, but it absolutely contributed to the overall negative sentiment towards the US dollar that was building throughout the week. It likely encouraged speculators to increase their USD short positions, acting as a sort of confirmation for those already betting on US economic weakness. In essence, yeah, it subtly set the stage for that big bad news is good news reaction we saw when the PCE data finally hit.
Got it. So what's the lesson here for our listeners about these softer sentiment type reports?
I think the lesson is that sentiment indicators can be really crucial leading indicators. While they don't always cause the immediate huge swings like hard data can, they shape the market narrative. They tell you which way the wind is blowing psychologically. And they can often foreshadow bigger moves that happen later, especially when that sentiment is eventually confirmed by the hard data, things like spending, jobs, or inflation reports. So don't ignore them.
Good point. Okay, let's jump north to Canada now. Canada's CPI, also June 24th. Did that manage to move the needle much for the loonie, or was it another case of being overshadowed by bigger forces?
Canada's May CPI rose 1.7% year over year. That was unchanged from April, actually. The main reasons were cooling housing markets and maybe slowing travel prices. Core inflation measures, they remained stable but still kind of elevated, above the Bank of Canada's target. This suggested the BBC might actually pause its rate-cutting cycle, so it slightly reduced expectations for another cut in July, and Canadian government bond yields might have nudged up a fraction.
Okay, that sounds like it should have had a clearer impact, maybe strengthening the Canadian dollar, but I recall the USD-CAD pair being pretty choppy around then. What specific external factors were strong enough to kind of neutralize a key domestic data point like that?
You're right, it was choppy. It caused some initial two-way volatility on USD CAD as the market tried to figure out what the BPOC would make of this mixed picture. It probably didn't cause a huge liquidation of positions. Traders likely just adjusted slightly. Sentiment was mixed, really. No strong directional narrative emerged for the Canadian dollar just from this CPI print. And this was a perfect example of a top-tier economic data point from one country being largely neutralized because stronger external factors were pulling in opposite directions. In this case, you had the combination of a generally weak U.S. dollar globally, which should push USD CAD down, but also falling crude oil prices, a key Canadian export, which tends to push USD CAD up. These opposing forces just limited any clear move based solely on the CPI data. It really shows how complex these interactions can be.
Okay, so context is everything. Now let's head over to Japan. We had Tokyo CPI and Japan retail sales out late on June 26th. Did this combination of data maybe push back expectations for the Bank of Japan finally starting to hike rates? Or was it just a blip on their radar?
Well, consumer inflation in Tokyo, it slowed quite significantly in June.
Yeah.
Both the headline and the core CPI figures came in at 3.1%, which was below forecasts. On top of that, May retail sales were also weaker than expected, actually down 0.2% month over month. So this dual dose of weaker data, it initially did cast some doubt on an early Bank of Japan rate hike. It put some downward pressure on Japanese government bond yield, JGBs, and reduced those BOJ hike expectations, at least temporarily.
Right, so the Japanese yen probably sold off initially on that news, making USD JPY spike higher. But you said it reversed quickly. Why the swift turnaround?
Correct. It caused an initial spike higher in USD JPY as the yen sold off. But that move reversed pretty quickly. Now, the initial spike might have triggered some stop losses on existing USD JPY short positions, but the fact it reversed so fast suggested new sellers came in, basically betting that the Bank of Japan would still have to normalize policy eventually, despite this 1 month slightly weaker data. So the initial sentiment was negative for the yen, focusing on the weak data means BOJ will delay story. But it quickly shifted to a more nuanced interpretation, something like, okay, inflation is still well above a 2% target, even if it dipped this month. The BOJ still has to act eventually.
So the takeaway here is that for currencies with these really big long-term evolving policy narratives like the yen and the end of negative rates, a single data point rarely changes the whole story overnight. The initial knee-jerk reaction might even be an opportunity to fade that move, betting on the bigger underlying narrative persisting.
That's precisely the key strategic lesson here, yes. Especially for the yen right now. The market's grappling with this huge potential policy shift. One data release isn't usually enough to derail that whole train of thought. Fading the initial reaction, betting on the persistence of the larger BOJ normalization narrative, that's often been the smarter play recently.
Okay, good insight. Let's finish our look at the U.S. data with the Q1 final GDP revision out on June 26th. What did the final numbers show, and did this just add more fuel to that bad news is good news fire?
Yes, it pretty much did. The final revision of Q1 GDP showed the U.S. economy contracted by 0.5%. That was worse than the prior estimate, which was already negative at minus 0.2%. And this downward revision was largely due to weaker consumer spending than they initially thought. So yes, it further solidified the argument for Fed rate cuts, contributing to keeping those Treasury yields low and maintaining pressure on the U.S. dollar.
Was this a big market shaker, though? Or more like, yeah, we kind of knew the economy was weak in Q1?
More the latter. It wasn't a major volatility event because, after all, it was a revision of old data from the first quarter. But it strongly confirmed that negative trend we were already seeing signs of. And it definitely supported that risk-on sentiment. We've discussed the idea that weaker growth means easier Fed policy, which is good for stocks. It probably didn't cause major position liquidation, but it certainly reinforced the conviction for anyone already holding U.S. dollar short positions. It strengthened that negative narrative around the U.S. economy and added more weight to the whole bad news is good news scenario playing out.
So even data revisions, which sometimes get ignored, can still matter if they confirm or intensify an emerging story.
Exactly. Revisions might be less attention-grabbing than the initial releases, but they can absolutely impact markets if they slot into place and reinforce an emerging narrative. They act like the final pieces in the macro puzzle, sometimes, completing the picture the market is painting.
Okay, makes sense. Finally, let's touch on something a bit different. The NATO Defense Spending Summit, June 24th and 25th. This sounds like a much more structural, long-term story for Europe, rather than an immediate market mover.
It definitely is. That's the right way to frame it. The NATO summit in The Hague, they announced a pretty ambitious target. Member states aiming to dedicate 5% of GDP to defense by 2035. That includes 3.5% specifically for direct military spending. Now, this commitment, if it's met, would represent a really significant fiscal stimulus for European economies over the next decade.
Right. But how did the market react in the short term? Or maybe how did it not react?
Well, the impact here is almost entirely long-term. You could argue that increased fiscal spending down the road might lead to higher future growth, potentially higher inflation too, maybe even higher ECB interest rates eventually. But the immediate impact on bond yields or currencies? Negligible. There was no immediate market volatility impact from this. It's a slow developing story. No immediate order flow impact either. While you could say it's structurally positive for the euro in the very long run, signaling European unity, investment in security, its short-term psychological impact was completely overshadowed by all the other economic data and the ceasefire news happening concurrently.
So the really crucial lesson here is that not every important piece of news is a signal for your day trading strategy. You have to distinguish between the two.
Exactly. That's vital. Not all important news creates immediate volatility. Traders absolutely need to distinguish between those short-term catalysts like a CPI report or a central bank decision and these longer-term structural trends like defense spending shifts. These long-term trends, they shape the currency regimes over years. They set the underlying backdrop, but they're definitely not signals for short-term trading. It's like understanding the difference between the weather today and the overall climate change trend, both important but on very different timescales. So looking back at the whole week, it was really defined by this tug of war. Conflicting macroeconomic signals on one side, pulling traders one way, and then this sudden powerful shift in global risk sentiment driven by geopolitics pulling them another. Our quantitative analysis, it clearly shows the market is operating in a really complex environment right now where those traditional rules and correlations, they're really being challenged, even breaking down sometimes.
Okay, so let's synthesize this. What were the absolute biggest moments that really shook things up this past week? And what are the core lessons we can take away as we look ahead?
I'd say the biggest volatility driver, unequivocally, was the US PCE report. That contradiction, hot inflation but weak growth, it forced the market to make a really tough choice. And it chose to fear recession more than inflation, at least for now. That caused a massive complex repricing across assets. And critically, that reversal of the usual stock market US dollar correlation, that was huge. The Middle East ceasefire was probably a strong second. It caused maybe a simpler reaction, but a very large repricing in specific assets like oil and the safe havens. Big, clear move there.
And for traders looking for those clearer signals amidst all the noise, which type of strategy actually worked best this week? Where were the opportunities?
Well, the best pure breakout strategy opportunity was probably Euro-USD right after that strong German EFO data. That was almost textbook. Clear positive signal, strong catalyst, sustained move. Classic breakout. In stark contrast, trying to trade breakouts based on the initial reaction to the US PCE data or even the Australian CPI data, those were more like false signals or traps. You likely got whipsawed if you chased those initial moves blindly. It just proves timing and context are absolutely everything.
Okay. And any common pitfalls or mistakes you saw traders making that our listeners should actively try to avoid based on this past week?
I think a really common mistake, and one we see often, is trading in a silo. Meaning, traders who focused only on a single currency's domestic story. For example, selling the British pound just because the Bank of England minutes looked dovish. Or selling the Aussie dollar just because its CPI was weak. Those traders generally got punished. Why? Because the dominant global themes, namely the broad US dollar weakness stemming from those US growth concerns, combined with that powerful risk-on wave unleashed by the ceasefire, they just completely overwhelmed those local factors. You absolutely have to zoom out and see the bigger picture.
Right. That makes perfect sense. So for a listener looking ahead to next week, or maybe even thinking about the next few months, what does all this imply? How should they adapt their approach to the market?
Based on what we saw this week, there are a few key adjustments to consider, I think. First, definitely increase your focus on cross-asset correlation analysis. That relationship between stocks, bonds, and the US dollar is clearly not stable right now. That DXY-S&P 500 correlation reversal, that's potentially a major regime shift. Your analytical models, your linking, need to reflect that currently, bad news for the US economy is being interpreted as good news for risk assets. Second, maybe prioritize relative value trades. With all these conflicting dynamics, just making simple directional bets on one currency carries pretty high risk. Trades that aim to isolate specific fundamental divergences, like that example of buying Euro GBP to play German strength against potential UK weakness, they might offer better risk-reward profiles in this environment. Third, think about adjusting your volatility strategy. The fall in the VIX index, the resolution of some key event risks like the ceasefire, It suggests we might be shifting, at least temporarily, from a high volatility environment to maybe a lower, more range-bound one for some currency pairs.
That might require a shift away from breakout strategies towards more mean reversion type approaches. And finally, keep a close eye on speculative positioning. That closing out of safe haven longs and US dollar longs was a major theme this week. The next CFTC report, that's the Commodity Futures Trading Commission data showing how leveraged funds are positioned, will be crucial. It'll help us see if this unwinding is a completed move, or if it's an emerging trend that could continue, setting the stage for potential reversals or further follow-through.
That's really practical advice. And just looking back at how different strategies actually performed this week, it's quite telling, isn't it? Breakout trading, as you said, was tricky, maybe only a 4 out of 10, with the US PCE being a clear bull trap.
Yeah, tough week for breakouts overall.
Mean reversion, though, that seemed to excel, maybe an 8 out of 10, especially selling those US dollar peaks after the initial PCE spike.
Yes, fading those initial reactions was often key.
Buy the rumor, sell the fact looked highly effective, maybe a 9 out of 10. Perfectly shown by selling oil and safe havens after the ceasefire was concerned.
Classic example, textbook execution worked well there.
And relative value trades like your EUR-GBP example also seemed pretty effective, maybe an 8 out of 10 as well.
Yeah, isolating those divergences paid off. This whole deep dive, it really just underscores the idea that knowledge is, well, it's most valuable when it's properly understood and applied. And that critical thinking is absolutely essential in today's world of constant information overload. You can't just react.
It really does. This week proved just how quickly those established market rules can be challenged, how the market itself is constantly evolving its interpretation of what counts as good news versus bad news. So what does this all mean for you, our listener? Well, I think it raises a really important question. How vigilant do we all need to be, constantly adapting our understanding of what drives markets when yesterday's certainties can so easily become tomorrow's traps? We hope this deep dive has given you a bit of a shortcut to being well-informed, maybe provided some surprising insights, and definitely some useful strategic lessons. Join us next time for another deep dive.